Hey everybody, it's Mr. Wagstaff. Cool stuff to talk about today. So today in our unit in Economic and Personal Finance, we're in Unit 7, talking about credit and debt. Yesterday we talked about different ways that you can get loans when you need money. Today we're going to start talking about what a credit score is, what credit worthiness is, and how debt can impact you and some strategies in order to manage your debt effectively. Let's go ahead and get started. So in our last lesson, we had talked about different ways of getting loans and interest rates. And at the very end, I had mentioned that one of the things that affects the interest rate that you get, because not everybody gets the same interest rate on loans, and you want as low as possible interest rate as possible, is your credit score. And you've probably heard this before, and you may have no idea what it is. Well, that's why Mr. Wagstaff is here. Today, we're going to talk about your credit score. So, this is an arbitrary thing. I say arbitrary, it's extremely important in our society. Very much like money, it's a man-made construct, but it is wildly important. You can mess this up really early in your life and not realize the importance and then spend like most of your life trying to fix it. So, you have to understand what it is and why it exists. So let's simplify this a little bit here. So a credit score is literally a number that is assigned to you. You probably already have one. If you have a social security number, you probably have a credit score assigned to you already, and the credit score changes. Now, all this is a number that basically tells banks how reliable you are at paying back your loans. Not just banks, but anybody that's going to loan you money. So there's one specific type of score that is used in America almost exclusively, and it's called the FICO score. All right. So your FICO score is whenever anybody talks about your credit score, they're talking about your FICO score. All right. So just a random little thing to know. It's called your FICO score. There's different ways of measuring your credit. The one we use almost exclusively is the FICO score. Here's what that means. It is a number assigned to you between the ranges of 300 and 850. All right. So your FICO score is somewhere between 300 and 850. The higher the number, the better. So if you have a score between 800 and 850, it's excellent. 750 to 799 is very good. Good is 700 to 749. Fair is 650 to you can read this. All right. Now, the importance of understanding this is based on your score is a lot of times the interest rate you'll get on a loan. And if you're at poor or very bad on this list, they're probably just going to say, no, we're not going to give you a loan. If you're at fair, they may say, we'll give you a loan, but it's this wild interest rate because they don't think you can necessarily pay it back based on this number. So your entire ability to get a loan and your interest rate and so much of your financial life comes down to this FICO credit score. So what is it and how does it change? So it's based on 5 factors. Your payment history. Have you consistently paid your bills in the past? Amounts owed, right? Do you owe like $500,000 already and you don't have a super high paying job? That can hurt your credit score. Length of history. Like, did you only just start taking out loans? Because they like to see like a long period of time that you've been taking loans out and paying them off. And we'll get to this in a second because it's a little counterintuitive. New credit. Have you just taken out a loan from somebody else recently? Then why are you needing another loan? Your credit mix, and we'll talk about that more in detail later on. So what's interesting here is you would think that like, all right, payment history, well, I've never had a loan, so I've never missed a payment, no amounts owed. You would think since you're probably not in default of any payments right now that you would have a really high credit score. You probably have an awful credit score right now because in order to have a good credit score, you have to show a history of having debt and effectively paying it off effectively and people getting their money back. If you have absolutely no debt and no problems and you're like independently wealthy and you're like fantastic, you would think you'd have like a perfect credit score. Actually, you might not, because what gives you a really good credit score is when you're in debt and you're consistently paying it off, but you can manage your own money and you're making enough money in order to take on more debt. All of these things affect your credit score. So your credit score is actually benefited by being responsible with your existing debt, because being irresponsible with your debt is absolutely going to destroy your credit score. And if you have absolutely no debt, you might not have a great credit score, because there's no evidence that banks know if they loan you money, you will pay it back, since you've never had to do that before. So it's kind of interesting how the best credit scores are usually people who have some debt, is diversified, and they are very, very good at paying it off and having a clear plan, and have been doing so for most of their life. So the question here is, what factors are considered when calculating the FICO score? So pause me, answer that completely, and we're going to move on. All right, so let's talk about debt management. So your debt is very important to your credit score, as we have been talking about this number between 300 and 850. All right. The amount of debt you has affects your credit score pretty drastically. So again, this is another graph, your payment history. If you have debt, one of the biggest impacts on your credit score is, are you paying your debts on time and fully? If so, your credit score is actually going to go up, and people would love to lend you money, because people want to lend you money if they know you're going to pay it back. If you have taken out loans before and been paying them on time and everything's good, your credit score is going to go up. The level of debt, if you have a manageable level of debt, they love to see that, because you can take on a little bit more. If you have too much debt, that's going to hurt your credit score, because they're like, we don't want to loan this person more money. I don't know if they can pay it back. They already have so much debt. If you have no debt at all, then they're probably like, well, it's probably going to hurt the age of credit, the other one there, because you probably don't have a lot of history of being in debt and paying it back, so they don't have anything to base it off of. But debt absolutely affects your credit score. But when you have debt, all right, and at some point you're going to have debt, there are different ways, strategies of working for you. Now, if you, like with a credit card, all right, the avalanche and snowball are two very, very common types of debt repayment strategies. This is usually if you've already gotten in over your head and you're like, all right, I got to stop spending on credit cards. The interest rates are getting to me. It's too much. This is commonly like early on, you got to stop it here. But if you're making your payments, you can just usually consistently make your payments if it's a closed-end loan like a mortgage. But if you want to attack your debt and get out of debt, all right, which means you're not having to pay interest rates, there's two ways of doing it. It's called the avalanche and the snowball, all right? So avalanche sounds like all at once, all right? And snowball means you start small and get big. Both of these are very effective. The main thing is to have a plan if you're in all this debt. So an avalanche is you attack the highest interest rates first, all right? You look at your debts and you're like, all right, I have a little extra money, but I can't pay off all my debts, like pay them down in addition to what I currently owe. So you pay off the ones with the highest interest rates early on, all right? Which is usually the hardest thing to do because they're high interest rates. But this basically, you're not going to see immediate results because you're having to pay off with the ones with the high interest rates. But by doing so early on, all right, as soon as you pay off the ones with the highest interest rates, you're going to realize that your net income and your disposable income has drastically increased. And then it's, as soon as you pay off the one with the highest interest rates, it's boom, 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 really easy to pay off the smaller ones. All right. So it's basically you do the most difficult one first, and then as soon as you've done that, hey, I'm not having to pay on that anymore. I have extra money, and you pay off the smaller ones. That's why it's called an avalanche, because even though you're not going to initially feel any difference and you're just like paying into what feels like nothing, as soon as one finishes, then you just hit all the other ones on the way down. The snowball is the opposite. The snowball is that you attack the smallest balance first. Your smallest debt that you have, let's attack that. This is good if you need to see results quickly. Like, hey, I've got all this debt over here, like a house, a car, and other stuff, but I've also got this credit card bill. I got $700 on it. You know what? I'm really going to focus on paying off this $700 credit card bill right now that I haven't been able to pay on because that keeps increasing. You pay off the smallest ones first, and that way it gives you a sense of accomplishment. Then you work up to the bigger ones. So the avalanche or the snowball, these are two very common debt repayment strategies that are commonly used in order to pay down debt, especially if they start to get out of hand. So the question here is, what are some strategies for effective debt management? And we just talked about those two. So you can use those as examples. So you can pause me, answer this completely. We're moving on. All right, so the entire purpose of having a credit score is to measure your credit worthiness. Basically, how worthy are you to receive a loan? So the credit score and credit worthiness are very heavily connected. In large part, in most loans that check a credit score, they use the credit score to measure your credit worthiness. So a lot of times the credit score is a measure of your credit worthiness. However, if you go, like maybe a used car dealership says, we won't even do a credit check on you, you're like, oh, cool. So there's like nothing, but they're going to want to see something. They're going to still want to see your credit worthiness. Like, I understand you might have made mistakes in the past. We're not going to check your credit score. But we also have to make sure we get our money back. Like if we loan you a car, we have to make sure this happens. So, or we sell you a car and there's a loan associated with it. We have to make sure that we get that money back, and they need to check probably your employment. How long have you been employed there? If you've been there multiple years and you're getting a consistent paycheck, okay, maybe you're in the process of rebuilding your credit, then that could be considered credit worthiness. But your credit worthiness determines whether or not you get a loan. If you are not considered credit worthy, you're probably not going to get a loan. This is like Mary Smith, 32. She's a dentist, high income, good credit history. Obviously, a bank's like, you can absolutely have a loan. All right. This is Andy Jones, 32. He's a bouncer. It's a random job, but hey, he's employed at least. Low income, very bad credit history, has a history of not paying his loans. They're not going to loan him money because they don't think they're going to get it back. But your credit worthiness, as we said, is directly connected to your FICO credit scores. So your credit score changes over time. It naturally is going to fluctuate over time. All right. Here's how to increase your credit worthiness and your credit in general is to pay bills on time. That number one, if you get behind on your bills, your credit score is going to plummet. Use 30% or less of your total credit limit. So based on your income and how much money you can pay on these bills every month, use around 30% or less. If you're at 50% of your credit limit, the maximum amount that you could pay, using 50-60% of that, other banks are going to hesitate to want to give you another loan if you're already so overwhelmed with your existing loans. And then diversify your borrowing. If you have some credit cards that you're paying off, you have an auto loan you're paying off, you have a mortgage that you're paying off, and you're just killing it on all levels, that actually helps your credit score because they know that you can kind of roll with the punches and that you are fluid in your ability to pay off open and close in credit and loans. Now, I don't know if this has popped in your head yet or not. It may have. You're like, all right, cool. So Mr. Wagstaff says I have a score associated with me. What is my score? So these are three very famous companies, Equifax, Experian, TransUnion. These companies all allow you to go to their website or their app and put in your information like social security number and stuff like that. And for once a year, they will tell you what your credit score is for free. And that you would need to pay for it. Now, this is another really weird thing. Your credit score is very touchy, all right? If you check your credit score once a year, you're fine. Nothing weird is going to happen. This is really important to do because you want to record your credit. Because if you've been doing everything fine, then you realize your credit score dropped 150 points. Then you need to go check in, hey, what happened? Sometimes a mistake happens. This is not common, but it does happen that somehow they thought you missed a payment here or there and you didn't, and you have to dispute that because then you get your credit score back up. You want to make sure because it'll tell you why your credit score is what it is. If it's really high, it'll list out why it's high. If it's low, it'll tell you why it's low. It gives you very clear feedback of why your score is what it is. If you disagree with it, then you need to go challenge it. There's avenues to challenge that, and they can look into it because they want to make sure that you have the right credit score. Nobody wants you to have a low credit score when you should have a high credit score, because banks want you to have a high credit score because that means they can loan you money and they know they're going to get it back. So they want you to have a high credit score. So if there's a mistake, you have to check it, all right? And you have to be responsible for this. Nobody else is checking your credit score for you in order for your benefit. So getting back to what I was saying, if you check your credit score all the time, for some reason, that's really bad on and it will actually hurt your credit score to check it a lot. That's why once a year, you're fine. I'm trying to think what I had done. I took a loan out for a car years and years ago, and I had shopped around. I don't remember exactly what the situation is. I can't remember what it is, but somehow they had checked our credit score multiple times, multiple different ways or whatever. And then I think I may have gone to another dealership because I wasn't happy with that one. It went all the way through the process, and they were really concerned when they were checking my credit score why I had like 4 or 5 different inquiries on my credit in the last month or two. And it was like a big red flag. I had to answer. I was like, well, I was looking for a car. I think I was refinancing a house, a car, something like this. But I had to answer for why did I have like 5 inquiries on my credit, because that makes them think, or like, you're taking a loan out from us. Is 5 other people about to give you a loan too? Because if so, then that can just absolutely destroy your credit because you're way over your credit limit. So you have to verify. So it is very touchy on your credit score. So you check it once a year and it's free. And this is usually at tax time. If you use like TurboTax or a company like that, a lot of times they will hook up with one of these. And when you do your taxes, it's like, hey, now's a good time. Go ahead and check your credit score. Want to go ahead and do that? So your credit score, these are companies that let you check it for free once a year, and it doesn't mess your credit up at all. Do it once a year. More than once a year, it can be an issue. But you do regularly need to review it. And regularly means once a year. Because if there's a discrepancy, if somebody's claimed you didn't make a payment and you did and it hurts your credit score, somebody typed in a number wrong somewhere and something and messes up your credit score, you need to dispute that, because if you let it go for multiple years, it's going to be hard to dispute it, and then you have to go through the whole process of trying to build credit again, which is what we're getting ready to talk about. So answer that completely, pause me, we're moving on. Now, I have talked how bad debt is, all right, because debt is dangerous. You're playing with fire. But the vast majority of people in America are in debt, all right? So if debt is so bad, Mr. Wagstaff, why are so many people in debt? They should just be like, I'm not going to be in debt. Well, there are advantages of debt, and some of them are pretty common sense, all right? So here's the advantages of debt, specifically meaning why are you taking out a loan? Why are you going into debt? So let's talk about the main one, access to funds. If you want to buy a house, and it's a $200,000 house, you don't have that in the bank. If you do, respect to you. Vast majority of people don't. You will need to go get $200,000 from somebody that will loan it to you, like a bank. So the benefit of going into debt is you can buy a house. You have access to funds to purchase a house. That is above everything else. That's the reason people go into debt, is they need money now because they don't have it and they want to buy a house and then pay it off over time. Houses are the most common form of houses and cars. So access to funds is a benefit of debt. The next one is it builds credit. When you take a loan out or you use a credit card, if you use a credit card, and now I've talked about the dangers of credit cards, it's a slippery slope, but if you use a credit card, just like say you're just using it for groceries, you get a credit card and you use it for groceries, and you know in your mind, all right, I've spent $500 this month on groceries, all right, $600, whatever, $500 a month on groceries. And you're like, $500 on groceries? No way. If you've never bought groceries before, it's one of the first shocking things of adulthood. Groceries are wildly expensive per month if you add it up over a month. So you spend $500 a month on groceries. If you had a credit card and you just use the credit card to buy your groceries, you know in your mind you've spent $500, right? And you've kept tabs on it. And as soon as that bill shows up at the end of the month for $500, you move it from a checking account, boom, pay off that $500 that you spent that month on groceries, and it's paid for, your credit scores will start going up. That means you are responsible with money loaned to you. And it's usually there's no interest as long as you don't miss a payment. So using your credit card responsibly will build your credit. It makes your credit score go up. Taking out loans, paying them off effectively on time, never missing a payment, doing it consistently over time, all of that builds credit and gets your credit to go up. So when you need a loan in the future, it will benefit. So building credit is increasing your credit score, which the higher the credit score, when you take out a loan, it's a lower interest rate. There's less risk of you disappearing on them, so it's a lower interest rate. So not only is it, are you getting a loan, yes or no, the better the score, the lower the interest rate. Another benefit of debt or taking out a loan is investment opportunities. Famous saying in capitalism, you have to have money to make money. You got to spend money to make money. Well, how do you spend money you don't have if you have $0? Take out a loan. So investment opportunities is a fancy word here. Like if you're going to start your own business, all right? Say you're a fantastic tattoo artist, you're a hairstylist, you want to start your own salon or your own tattoo parlor, all right? You probably don't have the raw money to start with. You'll have to take a loan out for your business. That is an investment. All right, so you take that money, you go into debt, you start a business, but you start making money off of the fact that you took money out and you're able to pay back that loan because you started a business. So that is another benefit of going into debt. All of this is predicated on having a repayment plan, though. You have to pay back the loans. There is no benefit to loans if you aren't paying them back, because it will just absolutely like access the funds you bought a house. We'll start talking about the downsides and the negative aspects of being in debt here in a second, but you have to have a repayment plan. All the positive aspects of being in debt are all assuming that you have a clear repayment plan and you are paying back your loans on time and effectively. So the question is, how can responsible debt management help individuals? So basically explain some of the benefits here of what debt can do for you. So pause me, answer that completely. We're moving on. All right, so let's talk about the disadvantages of debt. All right, so obviously the benefits are access to funds, investment opportunities, helps build credit with a smart repayment situation. Here's the downsides of debt. If you take out a loan, you have to pay that money back plus thank you money, which is an interest rate. So you want the smallest interest rate possible. Having good credit lowers that interest rate, which means you pay less back over time than you would if you had bad credit. But interest rates means you have to pay back everything that you borrowed plus extra. And that extra, that thank you money, is interest rates. So that's definitely a disadvantage of going into debt, is having to pay thank you money for having to take the money out. Another one, big disadvantage, right, is if you don't make your payments, you can lose it all right? If you default on a loan, means you stop making payments, all right? Bad things happen. So, top left corner here, if you take a loan out on a house for 30 years, you pay on it for 10 years and stop making your payments, the bank technically still owns the house. They kick you out of the house, the bank now owns it, they sell the house, they get all their money back, they're good, moving on. All that money you paid into for 10 years, you don't get that back, all right? They keep that and they have the house, all right? This is why banks love giving out mortgages. It's really hard for them to lose their money on a mortgage. If you default on a car payment, and on the top right, they will repossess your car. They'll show up in the middle of the night and they will take your car. They own it. Because again, when you take a loan out, the bank actually owns the car until you pay off the car. Like there's literally like a pink slip that you get that says ownership. The bank has that until you pay off your car, then they give it to you. So if you don't make your payments, they just show up in the middle of the night and take your car because it's not yours anymore. It's the bank's car because you defaulted on it. There's also all types of legal action and court fees, bottom left, that happens if you default on your loans. A lot of legal ramifications, and depending on the situation, can be drastically different. And then the bottom right crushes your credit score. If you default on a loan, the chance, it will just on your credit score. It'll just wipe it out. So you really, really, really need to make sure you don't default on a loan, because if you default on a loan, the ability to get any additional money loaned to you in the future is going to be like nearly impossible for quite a long time until you can find a way to build that credit back up. And it's really hard to build your credit back up when nobody will give you a loan. It's like looking for a job and they want experience, but it's your first job. So how am I going to have experience at a job when nobody will hire me? Very similar to your credit score. If you default on a loan, your credit score is trash. The only way to increase your credit score is to pay off your loans, but nobody will give you a loan because you defaulted. So defaulting on a loan and not paying your loans is just absolutely catastrophic in all types of ways. And also, and this should not be understated, how does debt affect your health? The stress and anxiety associated with this constant pressure of, oh my gosh, well, if I don't make a payment, I'm going to lose my house, I'm going to lose my car. This is why it's very good to have a debt management plan. Have a strategy. Know what you're doing, because if not, it is very overwhelming. There is a clear connection between mental health and having a lot of debt. Depression, anxiety, hypertension, behavioral issues in children. And you're like, what type of kids are taking off loans? Kids understand the environment that they're in. If they're in an environment with a high stress parents because of debt, it negatively impacts the kids. Stress, wild stress, like what am I going to do, because you can't control it, and less likely to seek medical care, in large part because you're in debt, and if you don't have the proper insurance or you're already crushed in medical debt, it's hard to seek medical help when you know that's just going to add to the debt, which is a lot of the reasons why you're having the medical issues anyway. So debt can absolutely wreck your mental and physical health. The question here is, what are the consequences of defaulting on a loan or a financial obligation? So we just got done talking about that quite a bit. So answer that completely. That's what I got for you guys today. See you guys tomorrow.